Billy, it's good to see you.
Yeah, good. Thanks for having me.
It's always good to chat here in Sydney, mate. And I know you've just come off talking China tech with some investors, and that's what we're going to spend a bit of today talking about because, well, China, USA, tariffs, it's been everything that anyone's talking about the last couple of months. And I think if there's like a moment in time when Australian investors look across the world and they think, well, the past 20 years of USA has been amazing, 30 years. What's the next 20 or 30 years across the globe going to look like? Like, is there another massive opportunity for investors to think about? And for a lot of people, the first thing they should be turning their attention to is the rise of China, and in particular, the companies that are going to ride that wave over the next 50 years.
Yep.
So we're going to spend a bit of time on that. But let's just start biggest possible picture, Billy, of like, imagine we've got thousands of investors listening to this. Like, why is now the time to just think China stock markets writ large?
Yeah, I think, look, it's a tough one, but I think the key to look at is everyone needs to understand and appreciate that China is a planned economy. And what I mean by that, China is not looking at the next 4 years. They're not looking at the 2 terms. China is always looking at the next 10, 20, 30, 50 years. And that's literally how they've planned it. You know, the 14th 5-year plan, their 10-year plan. So if you look in the past, you know, we've seen them go through manufacturing initiatives. They've gone through infrastructure. They've gone through property. Our view is that they're now trying to go through the innovation phase. So what we've seen is that in 2025, or even the last 6 months, I'm sure everyone's heard of a lot of these Chinese tech companies coming about, you know, BYD, DeepSeek, all these headlines. This is something I've tried to be clarified, is that this is not by luck. This is not by chance. What I mean by that is that in 2015, China had a policy, an initiative called Made in China 2025. So it was a 10-year policy, 10-year initiative that actually tried to push EV, semiconductors, robotics, AI, even green energy. There was an initiative 10 years ago to achieve world number 1 within these set of realms. And this is exactly where we are now, Owen. You know, China is about 60% of the global EV production. Robotics is also leading. Semi, we're getting there. But in terms of AI, we have the most patents as well. So I think the key to note of why now for China is that China is a planned economy, and we are seeing China double down on innovation.
I've seen so many different things recently, and I wrote about something recently about like even like the software and the innovation in software, like desktop computing, mobile computing, and the software that people actually use. Like so many of us are familiar with Microsoft Windows or iOS or what have you, but some of the open source Chinese software is growing rapidly. And that's something that should make all investors aware of, like the change in the mix, right? Even though we may not be using it here in Australia, there may be a huge opportunity abroad for people to look at. If we zoom in on just the tech, so just the innovation and just the tech, why should investors be paying attention now?
Yes. So I think, look, I strongly believe that innovation is everywhere. I'm not saying that China is the only place with innovation. We're still seeing innovation globally growing everywhere. So, you know, I have a view that, you know, innovation is borderless. But if you look at why China now is, like I said, you know, we've gone through 10 years of very strong policy support. And now we've also seen the next 2-3 decades of China double down on these policies. Though now we're spending much more on semiconductors. China is focusing on becoming real leaders, not in EV, but also EV battery or energy. They're also looking at improving their dominance in large language modeling and artificial intelligence through investments. They are looking at double down on these policies or on these initiatives. But more importantly, in terms of the urgency, it's also about valuation. You know, we have the fundamental base backdrop. We have the companies that are investable. We have the government policies, which are going to support this. But if you look at the valuation, and again, I'm just very abstract looking at Chinese tech companies and comparing it with maybe the global, let's say the Mag 7 innovative companies. And I think it's fair to say that the Mag 7 are the innovative global leaders. If you look at it from a revenue perspective, on average, the top 7 tech Chinese names or Chinese tech companies are growing faster in terms of revenue and in terms of earnings per share growth for the next 2 years. But the key for urgency, if you look at valuation in terms of PE, price earnings, these top 7 Chinese innovative companies are trading at least 30 to 40% discount to the Max 7 in terms of price earnings. So I think that's where we come in. There is that initiative by government, and there is that valuation attractiveness.
Interesting. Why do you think that exists? Like, why do you think the discount is so significant?
Yeah, I think, there's a few things. I think, China, tried to do this innovation policy or initiative around 2010. I think globally there was this race for innovation, for tech, whether it be semiconductors. And that's when the trade sanctions and the trade restrictions started. So there was a lot of restrictions in terms of technology globally, not just China.
Yep.
But China was hit hard because they had a very strong initiative. And so I would say that one of the discounts, or one of the things that people have overlooked, is because since 2010, China has been, I guess, omitted from a lot of new technology. And obviously the clear ones are semiconductor equipment, very limited from, I guess, NVIDIA, very limited from the Netherlands in terms of ASML. So these are all being factored in and priced in by investors. They think, oh, look, it's very hard for China to progress. And which is why I keep going back to 2025, that China has managed to achieve this self-sufficiency. And, one sort of example I like to give you is that, BYD obviously is becoming a household name. But at the same time, you look at BYD, they're just an EV manufacturer or a vehicle manufacturer. They are currently now 70 to 80% self-sufficient in terms of the value chain. They're producing their own design, technology, internal in technology, and also the batteries as well. And I think that shows the commitment and the view that these Chinese companies are looking at. They understand that, there is a lot of issues, but they're also looking at trying to complement and trying to run through the whole entire value chain.
You would know better than me, but I'm pretty sure China is way ahead in EV adoption compared to other parts of the world. This is going back a little while. I saw some statistic and I was just blown away by the adoption of electric vehicles.
Yeah, definitely. Look, I don't have the exact number, but in terms of the ratio of electric vehicle charges to electric vehicles, China is one of the highest in the world. And I think that just shows their commitment to infrastructure. And I always think that in terms of new innovation, infrastructure is a big hurdle. And I think that's what China was doing. They tried to overcome the hurdle by building out that infrastructure, which later allowed more, I guess, penetration of the EVs. And you see a lot of different areas and countries, they do it on the opposite way. They build out the actual technology and then they realize, the infrastructure is actually the hurdle. And we've seen that in several areas. Even in the US, there's actually not sufficient charging stations for the electric vehicles, which is now they're trying to build it out.
Yeah. And Tesla's probably been the only one that's really, of all the big players, I think everyone else has basically given up in the US.
Correct.
So,
correct. I think, it's much, the push is probably from Tesla themselves trying to push out that infrastructure rather than any commitment by local governments.
Yeah, to try and maintain some sort of advantage there, I guess. One of the conventions, just a kind of a basic one, Billy, is for people to understand is the difference between H shares and A shares. Can you clear that up? Because most people invest in the US or Europe, they're not always familiar with that type of naming convention.
Yeah, look, it's a good question because look, I've worked with both in the past and I love answering this. So, for any investor to invest in Chinese related shares, there's a few ways. One is through Hong Kong, as the gateway to China. And so any Chinese shares that are listed on Hong Kong are called H shares by nature. A shares, on the other hand, are Chinese companies listed domestically in the Shanghai Exchange or the Shenzhen Exchange. And so the key difference is, as we know, China is capital market has been controlled. The currency is being controlled. So in terms of the currency, in terms of Asia market, it's pretty much domestic players and domestic investors because, it's very hard to get access to the Chinese renminbi or yuan. And so the key gateway to Chinese investments have always been H shares in Hong Kong or even some that are listed in the US. Now, what's been happening recently or interesting is that, look, a lot of investments happening through Hong Kong shares, H shares, but because China needs to open up, they need to understand that investment is, capital is required. There's now a Stock Connect program, which means that foreign investors can invest in A shares selectively through Hong Kong through the Stock Connect program. So, for instance, let's say there's about 4,000 names on the Shanghai Stock Exchange or 3,000 or so. There are now probably close to a few, sort of close to 100 names which are now accessible from Hong Kong. Without that. So, this is the Stock Connect program, which is trying to open up foreign investors to China's market. And this is gradually happening. And the number of Stock Connect names is also increasing. Interesting.
So I feel like maybe it's different, but I feel like India had a similar approach where it was really difficult for foreign investors to buy shares directly in India. But we've started to see that somewhat open up as well. Maybe this is a basic question and shows my lack of understanding, Billy, but why hasn't it been more open?
Yep. Yes. Yeah. So especially for China, it's mainly because of the capital control, the currency control.
Right.
They control the renminbi. If they allow freely investable into China, that means they'll have to free up the currency as well, which has always been a strong seller point in investing in China. So I think that was always the hurdle. Obviously, Hong Kong was always becoming the gateway in terms of transferring renminbi to Hong Kong dollars, which is pegged to the US dollars, which is continually happening. There's no sort of, challenge to that. But again, now they're setting up just more gateways in terms of investing into China, and Stock Connect has been very, very active. I think by the last time I looked at it, Stock Connect transaction or trades has reached about 20% of total trades in Hong Kong Stock Exchange. So it's becoming a large amount. So essentially, these are all Chinese trading in Hong Kong exchange. Yeah. So this is becoming a formidable force. And I think people need to realize that there is that opening access to China capital right now, or to China investments.
Do you foresee that ongoing? Like, do you see that more and more of that will open up over, say, the next decade?
Definitely. I think not just in equities. And one of the key examples that they're also opening up the fixed income, the credit market in terms of a Stock Connect flow as well. So, this is not just restricted to just one asset classes. It's opening up to several asset classes, which, to your point, is simply opening up the whole entire market. Timing wise, it's a tough one. Obviously, politically, it's always hard to track. But, looking at the trajectory and what's happened in the past decade, we could see very decent or very large amount of asset classes being readily available to foreign investors, from China.
Yeah, because so GlobalX, and a lot of it's thanks to your handiwork, just launched the GlobalX China Tech ETF. DRGN is the ticker symbol, DRGN, which we'll talk about in a minute. But with everything that had been happening with the tariffs and things recently, and seeing that the household favorite on the Australian Investors podcast is FANG, it's like probably the most talked about ETF. That's what really got me thinking. And then we found out that this ETF was coming to market. Having the ability to access like just a really pure exposure to the best, most innovative companies is really important to investors. And so, I think the best way to illustrate that for everyone listening is through the lens of actual companies, which I know you absolutely love talking about. So let's go through some of these names. One of them I'd never heard of until you told me about it just before, which I should have known. So we've got on the list Tencent, which people will be familiar with, Cattle, which we'll come back to, BYD, which we briefly mentioned, and Alibaba. Alibaba people will also be somewhat familiar with. Take them in whatever order you want, Billy. This, I think, illustrates the scale, the potential, and what's on offer.
Yeah. Let's start off with the easy ones. And, just bear in mind that our fund constitutes of about 20 names. And, we've just named a few. But, the key sort of holdings are what you mentioned. And we've got Tencent, which has been, I would say the household name of China or even Hong Kong. It's listed in Hong Kong. It's one of the largest internet companies. Started off as an online games company, gradually became a more social company. And its big break was when it introduced the WeChat function, which is WeChat. The app is essentially our WhatsApp, our key social communication and messenger. So with that messenger app, it's expanded from anything, to do payments, e-commerce. And right now, I guess the last 4 or 5 years, because of that, user base, they've also ventured into AI. So they have their own large language modeling, and their also own build out of monetization and sort of commercialization abilities. And this is the same as Alibaba. Alibaba was set up as a large e-commerce company. They've built their business. They've built globally their business. They ventured into cloud. In the last 5 years, again, they're also venturing into artificial intelligence, building one of the best language models in China right now called the QN model. So these are the two sort of more old school internet models which created this sort of size, cash flow, and went into AI. But going to your question about the other names, BYD is interesting. People are hearing more and more about it, especially in Australia. I just realized that looking at the numbers that in terms of new EVs sold in Australia, 15% of that is actually BYD models. So BYD has a large EV market share in Australia right now.
You're seeing them everywhere.
I know. And, you're seeing BYD Utes was probably one of the most incredible things I've seen as well. So BYD is one of the largest EV manufacturers in China. Like I said before, this wasn't by chance, it was by design. China pushed them. They wanted them to be the national champion. And that's what they did in the last 10, 20 years. But not only that, it wasn't just about becoming an EV champion. It was also about that vertical integration I kept talking about. So right now, BYD has formed from a vehicle company and an auto company to being close to fully integrated and vertically integrated from batteries design as well. So I think this is something that's interesting. And looking at BYD, their incremental growth is now actually not from China, but coming from overseas. They're exporting to Europe, exporting to Australia. Now, looking at some sort of more lesser known names, like the one that you mentioned, Cattle, which is CATL, and that's listed in the A-share market. Now, this is interesting because Cattle is actually the largest global manufacturer of EV batteries. They supply to Tesla. They supply to most of the foreign firms that are making EVs. And again, this is by initiative. This China's initiative to create the largest EV battery manufacturer 10, 20 years ago. So Cattle now controls close to about 36% of the global EV battery production.
Wow.
They've gone quite big. They've got good cash flow. And recently the news is that they're also now dual listing in Hong Kong now. So this is a really big step for a company to list in the A-share domestic market and also list in the Hong Kong market.
Is that because of increased? Why is that a big step? Is that just to showcase that this business is going to be more readily available to global investors? Is that what it signals?
I think that's a good point, Owen. And I also think, when they do list on the H-share, it also means that, this is now like a global champion, not just a national champion. China wants to keep the national champions incubated in the A-share market, so there's sort of limited foreign control. When they're ready to go into the Hong Kong market, it means that, hey, look, everyone can buy it now. We're happy for it. This is a company that we're happy solidify its market share. And I think that sort of double downs on what we're saying before. So that's been incredible. And then, even in our fund, there's lesser known names, like even not just that, but there's a company called Innovance, which has been very interesting because Innovance is a very old school company in China, which used to simply make logic gate, which is just the computer gate chips, which allows industrial machinery. And just by that nature, they've been sort of building out all this industrial manufacturing, so little computer chips. What they realized was 10 years ago, they made it so well that they started automating sort of industrial manufacturing. Right now, most of the robotics installations in China are actually installed by Shenzhen Innovance. So for example, EV manufacturers or in terms of auto manufacturers, all these sort of big car vehicle manufacturing plants, which are automated, these are all sort of supplied by Innovance. This is now a robotics company. So you'll never guess a manufacturing company becoming a robotics company. So, and that's exactly what we're trying to do. Like we want to mention, we like AI, we like EV, we like robotics. And this is some of the few companies that capture this theme.
We talked about it just off air, actually. How Buffett and Munger through Berkshire were a massive outside investor in BYD, not Tesla, but BYD. So, and that was a long time ago. They must have also saw the writing on the wall with that, right?
Yeah. Look, I think that goes back to your question of why there is an urgency of looking into Chinese innovative stocks. And that's because Buffett, Berkshire Hathaway, 10 years ago, they saw the China initiative, Made in China 2025. 10 years ago, they knew that China was pushing this. They knew that BYD was being, pinpointed as the national champion. And that's what they, I guess, put their investment or put their pun on. And why I keep telling investors about China innovation now is because there are policies right now that China is now pushing semiconductor, EVs, robotics, automation and AI, and we need to take that advantage. This is exactly just like what Munger and Buffett was doing 10 years ago, and this is sort of our chance to actually do the same and sort of invest in that sort of multi-bagger 10-year development.
Yeah, I saw there was some drone footage recently of a BYD, I'll call it like facility. It actually had accommodation at this like mega factory, so people could stay there. It had like a village. It was like incredible. Mike, I got a question around this. So say, for example, like say if Buffett and Munger saw this over a decade ago, let's say, and the idea is like great companies, national champions start on A shares, move to H shares once they become more globally
Not
accessible.
all the time, but generally, yes.
Yeah, generally, yeah. But maybe in the future they don't even need to do that,
yes,
right?
Yes.
From like an initiative perspective, because I see this as like if I was sitting over in the US and I was seeing this taking place, I would be saying to the CEO of Microsoft, the CEO of Apple, what do you need to still be number one in the world? Like, what is it that you need, right? Because China's definitely shown that they're leading by example. They're saying, we want you to win. We'll do what it takes for you to win. But then my question is really, on the other side is, do you, like from an investor perspective, like us sitting here in Australia wanting to invest in these global champions, right? Do you foresee over the next 10 or however many years that investors will have the same kind of, I don't know what the right word is, but maybe the same kind of respect for like how the Chinese government views investors? Does that make sense? Like, so like you can invest in the US and you know that like you're going to still be able to hold those shares in 10 years and everyone loves capitalism, right? Investing with conviction for the next 20 years in China because it seems so much more appealing. Yeah. Do you understand what I'm saying?
I think there's a few layers I think where we're talking about. I think in terms of just looking at investor and shareholder corporate governance in Asia and Asia. I'm not sure if this is what you're alluding to, but look, this has improved substantially in the past 10 to 20 years. I mean, one thing that I keep telling investors is if you look back about 5-6 years ago, there was a huge crackdown on Chinese tech companies.
Yeah.
This was a crackdown on, whether they're anti-competitive, whether they're monopolistic. It was a lot of these. This is way before there was a crackdown on Meta, Google, Amazon, etc. So, China was doing this on the advent that they're trying to improve corporate governance. They want things to be better. So, I know there's a lot of, corporate governance issues dealing with China, obviously the capital controllers, but we're also seeing strong development. And, I think one sort of clear thing is also just what we talked about, companies shifting from A shares to H shares. H shares is in Hong Kong. Hong Kong is still based on the common law. It is still very much regulated and very much respected. So I think there should be that certainty of how that goes about. But in terms of, I guess another way to look at it is, should like the countries be incubating companies and then when it's sort of bigger, then sharing it with more bigger market? Look, I think, it's something that's worked for a lot of governments, not just the Chinese. I think, the government, such examples such as BYD and cattle is becoming very clear examples where, look, obviously Chinese was taking it as if the government was taking it as like a private equity. They were trying to build out that business, innovative. They took the risks. And then when it was a much more secure company, then they sort of put it out and then sort of allow investors. So I would see more of that kind of model where the government was taking a more sort of VCP approach. And then when it is sort of at a better phase, then they sort of allow more public investors and at a later stage, more foreign investors.
Yeah. And you can understand it, right? Because if they just opened up the floodgates to these companies, you probably would just get a foreign private equity firm that just swoops in and buys the whole thing and then it's in their control now, so it's totally different.
Yeah, and which is fine. I mean, this is how a market goes. But at the same time, if they did see a specific sort of way to actually develop it, like for example, BYD becoming fully integrated or fully vertically integrated, maybe a PE investor would not have seen that, and that would have changed the entire course of history. So there are sort of pros and cons, between capitalism and sort of government control, whatever. But seems that there is some kind of strong development, especially with the innovative side in China, that's been happening in the past two decades.
And the way I think about this, and probably the way I'm thinking more about it, Billy, is like when we talk about these, we're about to talk about the ETF, but when we talk about the companies as well, Australian investors here sitting here looking abroad should be thinking, in my opinion, I want some exposure. I don't need everything invested in H shares or A shares or whatever, but I should have some exposure. Because what if this is the new FANG? Like in 20 years and my kids are going to be saying, well, why didn't you buy that? Like it's so obvious, So, but you don't need to go all or nothing. It can be an iterative approach. You invest, you learn, you invest, you learn. Speaking of which, new ETF, Dragon, which makes a lot of sense. China Tech, you played a big role in bringing this out, and the team internally has done a great job of bringing this out. Tell us about it.
Yeah, look, first of all, it was a multi-team effort. We had product team, we had the investment strategy team, we had marketing, sales team, all contributing to this. And I think that's sort of what made it interesting. And one thing I keep telling clients and everyone is that, for me, an ETF issuer is just it's more like a pharmaceutical company. And what I mean by that is that we try to create products that try to solve solutions and solve issues by the market. So, and what we saw with the market was that there was a lacking tech focused product in the market, and one that also had a China focus, and that's why we tried to sort of fill in this gap. And going back to your question, I think we tried to sort of a few things. We tried to go, okay, we must be focused on innovation. It just can't be AI. It has to be multifaceted, which is why we're looking for a model where it includes AI, EV, robotics. It has to be somewhat concentrated, and that goes back to your point of we had the FANG. Is there potentially going to be a China FANG, which is again our investment thesis. And then I think one of the key things we look at is it can't be just momentum driven with the largest names. It has to have some kind of systematic basis of selecting the names, which is why in our fund, the China Global X ETF, China Tech Fund, it's also styles and factors based as well, which we could talk about.
Let's talk about that. Why is that the case?
Yeah, so I think a few things. So, look, in terms of, the Dragon product, the universe is, like you mentioned, we're trying to capture both A share and also the Hong Kong shares. So that includes any shares from A shares, Shenzhen, Shanghai listed, and also the Hong Kong listed. So that's the universe. We want it to be tech focused. So we use a FactSet based sector or industry selection. And that's probably about 10 to 11 sectors, which is tech based. And that's very straightforward. And now just going down in terms of the contribution is we want to be concentrated. So about 20 names. And it's always going to be 10 names from the Hong Kong side and 10 names from the A side. So that's going to be fixed. But in terms of weighting, that changes. Now, you talked about factors. We wanted that because we wanted something that's, more systematic and, more things that's trying to capture growth. So what we did was that we used about ranking system that ranks these names about 30% of 30% based on the market cap and turnover. So that's sort of a big ranking score. But we also rank these names by sales growth. And obviously because innovative names are based on sales growth. And we also rank it by earnings growth. Okay. And earnings growth is weird because everyone's like, hey, innovative names don't really care about earnings. But I think it does matter at this stage because we need companies which are profitable. And that these are the key names that generate a lot of income. The final sort of factor we look at is cash flow yield. And that's because our view is that cash flow is one of the things that sustain innovation. Without cash flow, you can have a lot of good ideas, but nothing to reinvest. The success of FANG was also based on cash flow. So in terms of our selection criteria, it's 20 names based on market cap, turnover, earnings, sales, and also cash flow. And I think that's sort of why we're trying to select or how we're trying to select these sort of top 20 tech names from the A share and H share market.
It's interesting that you say a big part of FANG's success was cash flow. When you think it is, I've never really thought about measuring it from that perspective, kind of like the back end. But if you kind of made a factor model for FANG, it would probably be something like that, like consistent sales growth plus cash flow, right? Free cash flow, right?
Correct.
Because like even things like Amazon, like not always had earnings, but you knew it was like really cash flow positive if you looked into the numbers.
You're right, Owen. And I think a lot of people, whenever they look at the FANG names, they think, oh, it's so expensive, it's overvalued. But then when you look at it from a cash flow yield perspective, it's very well attractive.
Yeah.
And that's because they're generating yield, and that's what people are looking at because, what makes a company survive? Not the revenue, it's the cash flow. As long as there's always cash flow, the company will always be there. And I think that's one of the, I wouldn't call it the secrets, but one of the key things for innovative companies because they might be looking at earnings now or even 10 years, but when they have that cash flow generating all the time, the earnings are going to come in after even a decade.
Yeah. What is the weighting methodology?
Yeah, so we used a weighting cap of about 8%. So 20 names, 20 names 10 from 8, 10 from 8 shares. Selection criteria, like we mentioned, in terms of the weighting there, it's market cap weighted, but it's capped at 8%. And the reason for 8% is, I always make this joke is, because not because 8's a lucky number in Chinese, but it's because this is a game gone through test and trial. We went from 15%, 12%, 10%, 8%. This is through testing, and we found that 8% was the most optimal. So to give you more context is that right now, or as of the latest holdings, the top 10 holdings account for about 60 to 70% of the weight. And I think this is very optimal, when you have a portfolio where there's 20 names, half of it is about 60%, 70%. And that probably gives a very, very nice mixture of growth and also risk reward.
Yeah. Do you think that, because FANG's 10, right? Do you think that over time, I think the thing that people like about that is the concentrated nature. So this is probably like that, except you've got a little bit more of a tail on the end, which probably makes people a bit more comfortable with it, I guess, as well.
Yeah, I think that's a really good point. I think the selection of why 20 names was, look, obviously FANG really worked well, 10 names, highly innovative names, highly growth names globally and the US. But I think what we have to realize in China and what we've discussed is that there's still a lot of some smaller players which are national champions or building up to be national champions, which we need to sort of select. And if we just select the top 10, we could bear the risk of missing out these growing names. And I think that's why we went for sort of a larger subset of names. And, it seemed in terms of backtracking, it has worked.
Yeah, fair enough. But I've probably got one more final question on this, which is, how do you see people using Dragon in a portfolio?
Yeah. So I'm really adamant that this is a tech first and China second fund, but obviously, there is a China component as well. How I look at it is that there is a very strong innovative tilt. So for example, if you've got a IT portfolio with 20-30% of an IT tilt or a tech tilt, and you're looking for something cheaper, this is also a very good inclusion. Like I said, the China tech names are trading at a much cheaper valuation, 30-40% discount to its US counterparts or the global counterparts. So there is that combination that allows for better valuation. And number two is exactly what we're saying about this China tilt as well. If your portfolio does not have a China tilt, you want something that's resilient against all this trade and geopolitical uncertainty. Tech is definitely one where you want to be exposed to, and government-backed policy areas is where you want to be. And this is sort of where China tech comes in as well. I mean, look, there's a lot of manufacturing discussions and risks, with trade policies, but tech is somewhere where, you don't really get impacted. And if it's backed by government for the next 2 decades, we still have a very, very strong sort of mitigation factor in the back.
Well, Billy, this has been really, really interesting to me because this is exactly what I wanted to talk about and to have a better understanding of it all. And the launch of the Dragon Fund is fantastic. And I'll put links in the show notes to that so people can explore more of the literature, that not just about the fund and the holdings and all that sort of stuff, but all the stuff you and the team are putting together around the outside. There may even be like a webinar or some type of event in the future to talk more about this. And if people are interested and you want to hear more about this, please write into us, because we can put them to Billy. We can do like a Q&A session with Billy on all of the questions you might have, whether it's about the companies, the ETFs, the strategies, how to think about investing in China. Because I think when everyone, like most people on the show, have a bias towards technology, I would say fair to say, because we see we want to invest in forward-facing businesses, right? But I think if we take a 20-year time horizon, this is a really rich conversation for them, Billy, because it's an opportunity for them to stop and pause and be like, well, how much of my portfolio do I want dedicated to this? Yes, it's a new market for me, but it seems like everything has already been going in that direction anyway. So should I be paying more attention? You know what I mean?
Yeah. And it goes back to your example of why did Berkshire Hathaway go into BYD 10 years ago? And because do you want to be at that point or maybe a later point? And I think,
exactly. Yeah. So this has been great, mate. I really appreciate you taking the time to explain this all to us and just being very generous with your insights.
Thanks for having me.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.